Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. This is my regular monthly commentary on international monetary developments. But this time I'm not going to be talking about the globe as a whole, I'm going to be talking about the United States of America. Now, in these presentations, there's a consistent background theory that in the medium and long run, the rates of growth of the quantity of money broadly defined and the rates of growth of nominal national income are related, so that rapid growth of money causes inflation and contractions in money cause deflation and recessions. And then in all of this, this is just examples of applying the monetary theory of national income determination. Now, I'm going to be doing that again in this session, but I want to cast our mind back almost 3 years now to early 2020. I'm going to discuss that, and then we're going to fast forward to 2023 and 2024. Now, back in March 2020, it became evident that the world was facing a huge medical crisis with COVID-19. It was an unprecedented challenge, a remarkable medical situation, and policymakers on the economic front reacted in an unprecedented and astonishing way. And to remind, in the United States, the Eurozone, Britain, and other countries, the central banks purchased assets from the non-bank private sector and caused huge increases in the quantity of money. Now, there were all sorts of reactions by economists to what was going on. Most economists thought that COVID-19 implied a few years of disinflation, falling prices, and so on. My view was utterly different. It was that the consequence of the dramatic increases in the quantity of money that we were seeing in March, April, May 2020 would be an inflationary boom in 2021 and then an inflation problem for the next 2 or 3 years. Of course, in practice, I've been right, and the great majority, the consensus of economists has been wrong. But I want to recall what I said in a special email back on the 30th of March 2020. I said there that this is when I made these correct, and if I may say so, absolutely brilliant forecasts. I said 30th of March 2020, a week ago, I proposed that US money growth over the next year might be 10% to 12.5%. A correlation does hold over the medium term between increases in the quantity of money and increases in nominal GDP. Given that money and nominal GDP do track each other over time, it seemed plausible also to propose that inflation might reach 5% at some point in the next 2 or 3 years. But then that was kind of 20th, 21st of March. Now another email of the 30th of March 2020. I now feel that I was being too conservative. The annual rate of money growth for spring 2021 in the United States might be between 10% and 15%, perhaps even heading towards 20%. If so, the right sort of maximum inflation rate to expect in the next few years would be in the 5% to 10% band. Let me just repeat, this forecast was made at the end of March 2020 using money supply developments. Let me just show you a couple of pieces of evidence behind all this. The first is the medium-term relationship between money and nominal GDP growth that I've just spoken about. You can see decade by decade how this has panned out in the United States. And then here's this extraordinary chart, quite extraordinary chart of showing the stability of money growth in the USA. It's both the annual rate of increase and the annualized rate of growth in the last 3 months. This is the, for the United States, the stability through the 2010s, and then that incredible surge just at the very end there, which is really relating to the April-May 2020 figures. Now, in fact, I was making these forecasts at the end of March 2020, and you'll see I was referring to a change in just 1 week. Why? The answer is that in the United States, there are weekly figures that throw light on these matters. The Federal Reserve publishes a H8 press release on the assets and liabilities of the commercial banking system. The great bulk of money is bank deposits, and bank deposits are a liability of commercial banks. So that weekly figure for deposits gives us quite a good clue as to what's going on. Sure enough, there's a separate press release, the H6 release, comes out monthly, which has more refined, more precise numbers for the quantity of money. But with those weekly figures for deposits, we can get some insight into what's going on. And it was on the basis of what happened in the final week of March 2020, when the level of deposits rose by getting on for 3% in 1 week, that I then made these very strong forecasts of inflation over the medium term. Okay, I'm not trying to conceal the secret behind my accurate forecasts. I want the world to understand how I analyze this problem and the kind of insights that it gives me. What about now? Well, what I've done in this chart is to look at the growth of deposits using this weekly press release in the very recent past, and then going back, in fact, to 1970. You can see, looking at this chart, that leap upwards in 2020 completely different from the previous decades. And then a fall away, just at the end of that blue line, a fall away into negative territory in recent weeks. This is starting to come through in the monthly numbers, but not that definitely as yet in the monthly figures, just starting to come in. And here I've put a shorter time span, in fact, just going back to the start of 2020, you can see that extraordinary leap upwards in spring of 2020. Still rather high numbers through 2021, and then falling away at the end. It's this falling away at the end that I want to focus on today. A sort of surge and slump that I said at the start that rapid growth of money causes inflation, contractions in the quantity of money cause deflation, recessions. That's what we're going into now in the United States of America. One way of looking at all this is to adjust these numbers for the inflation rate. The impact of a 20% growth rate of money on the economy is different if inflation is running at 20% when there's no increase in real money balances, from if that 20% increase in money occurs when inflation is zero. Obviously, in the second case, you're getting quite a lot of stimulus to the economy because real money balances are soaring, which means strong balance sheets, which means rising asset prices, which means buoyant economic activity. And therefore, we want, in terms of looking at the future, we want to get some sense of how money and inflation are proceeding, looking at the growth of real money balances. This is the real deposits figure going back again to 1970. You can see there the final value, the annualized rate of change of real bank deposits in the last 3 months in the United States is minus 9.9%, practically minus 10%. You can also see from this chart just how exceptional values of that sort have been. In the very long run, the growth of real money is similar to the growth of real output. They're related. That's the implication of the monetary theory of national income determination. But you can see here that at the very end of this chart, money is, well, almost collapsing. You have to go back to the 1970s and 1980s to find something of this sort. There was a similar fall in real money balances in real deposits, bank deposits, in 1974, ahead of the recession of the mid-1970s. And there was similarly, in fact, a somewhat larger decline in the rate of monetary growth in the Volcker double-dip recession of the early 1980s. My point here is that the monetary squeeze in the United States is now the most intense since Volcker's double-dip recession of the early 1980s. Implications for next year, there's going to be a recession in the United States. Obviously, we don't know yet the precise intensity, duration of this recession, but I think a reasonable point of view is that it'll be similar to that of the mid-1970s, when GDP fell by about 3% between the end of 1973 and the first quarter of 1975. I am worried that the Federal Reserve will overdo this. The Federal Reserve doesn't analyse the situation in the same way as me. They look only at interest rates. They then have all sorts of weird and wonderful models that don't help them when they try and forecast the economy. If they did look at this, they would know they should not now be overdoing the monetary tightening. I'm afraid they may keep the sales of assets that they're doing, keep them at the same level as at present, and we'll see this monetary contraction persisting, persisting for too long. Anyway, I'm just trying to highlight the dramatic change in the American monetary situation in the last 2 or 3 years. A couple of reflections, a couple of final points I want to make. To me, what's happened in the last 2 or 3 years is an impressive vindication of the quantity theory of money. Anybody looking at analysing an economy must look at what's happening at the banking system, must look at what's happening to the quantity of its deposit liabilities that constitute the bulk of the quantity of money. They must do this. That isn't what most American economists do. It isn't what, say, for example, Larry Summers or Paul Krugman does. Paul Krugman, in his column in the New York Times, always scoffs monetary data and just focuses entirely on interest rates in the kind of things he says about the business cycle. There was a lot of work done on this subject many years ago by Milton Friedman and Anna Schwartz, work that's influenced me. And Anna Schwartz said 50 years ago that the correlations between the level or rates of change in interest rates on the one hand and the rates of change in nominal income prices and output on the other are considerably worse than those between rates of change in the quantity of money and these magnitudes. She was right, looking at the data in the decades running up to the 1960s when she said that. I've done a little bit of work of my own on the same topic, which I published, in fact, last year. And this is the relationship between the growth of American GDP and the level of interest rates, inversely, because lower interest rates are, the faster should be growth, according to theory. This is a relationship, well, there isn't one. There's no relationship between the inverse of interest rates and the rate of growth of US GDP. It just doesn't work. There is one, not a particularly precise one on a year-by-year basis, but there is one between money and nominal GDP, just as Anna Schwartz said. One final quote I want to make on this whole episode. This is something that appeared in the latest newsletter from the Royal Economic Society. It's by a journalist, a chap called Nicholas Wapshott, quoting from his book, referring to his book, Samuelson Friedman. And what he said there was, this is about what's happened in the last couple of years. He said, Friedman was the best known economist in the world when he died in 2006, with his monetarist theories largely ignored. When high inflation returned in 2021, Friedman's monetarist solution was again rarely mentioned. Look, it isn't a question of how often or rarely some facts are analysed and mentioned. It's a question of what's true and what's false. The fact of the matter is that the sharpest acceleration in money growth in 40 years was followed by a sharpest acceleration in inflation in 40 years in the USA, the Eurozone, and the United Kingdom. The quantity theory of money is correct. In that sense, Milton Friedman's work remains hugely relevant and important, and he does not deserve this kind of treatment. Thank you.